You went to the daily chart and identified a clear bearish draw on liquidity. Then, you dropped down to the 4-hour chart and noticed that price was sitting right inside a 4-hour bearish fair value gap. Next, you moved to the 15-minute chart, which is your entry time frame, and you saw a market structure shift to the downside, forming exactly at that 4-hour bearish fair value gap. With all time frames aligned to the bearish side, you confidently took the trade. You were so confident, in fact, that you even called your mom to ask if she'd like a pink G-Wagon for Christmas. But right after you entered the trade, price pushed up, tapped your stop loss, and then immediately reversed back down to your take profit. So what caused this? In this scenario, it was the lack of displacement after the market structure shift. When you look at the first market structure shift, there was no displacement. However, after price stopped you out, it created another market structure shift. The key difference between the first and the second is that the second one had displacement, which left behind a fair value gap. If you had been patient, you could have taken your entry from that fair value gap, and the trade would have been a winner. Anyway, just tell your mom that Mercedes-Benz doesn't accept crypto. That's why you couldn't get her the pink G-Wagon. Follow for more.